Good morning, everyone. Great to see so many familiar faces in the audience. There are a few faces here that are required to be here because I have made my students show up for their final part of class, so thank you for coming. They've just spent 32 hours with me over a couple of months looking at how they build innovative financing instruments. I'm going to distill a bit of that for you in the next 12 and a half minutes, or how much ever time I have. Suffice it to say, it's a much larger and longer conversation. And I think that both of the past speakers, started to touch on prescribed assets, and it's something that we've talked about in South Africa for the past how many ever years I've been here, almost 7 now. And I think it's something that we do need to think more creatively about. So what I'm going to bring up is just a few different types of cases that we can see both in South Africa and globally, where we start to mix different types of funding. The thing to remember is that even in this room, there's different types of funders that have different risk-return paradigms. And so blending those different types of capital together can bring us to the place where we have the sum that is greater, the whole that is greater than the sum of the parts. And that's where we're going towards. If we're going to hit 2.5 trillion in needs for the SDGs every year, we're not going to do it with a few $100 billion. We're actually going to need the entire capital system to move. And people are going to do that based off incentives. Everyone operates on incentives. My students are sick of hearing me say that. No one does anything out of the goodness of their hearts, and I truly believe that. People operate off of incentives, whether they're personal incentives or their fund incentives or their mandates. So until those things change, people are going to do that. So there's one thing is that I think the work that Just Share is doing and others are really trying to change the system. And I really see that, and I think that's really important. There's another piece of saying we need to play with the rules that we have right now. So how do we use capital that is free to be able to do different things and potentially take on risk that might be perceived risk or might be real risk, and actually pull other types of more risk-averse capital into this function? So one thing I would just like to say is I would encourage, there's two things that I always say around language. One, I would encourage all of you, and we haven't talked about it yet, but to not use the word beneficiary, instead to use end user, because that gives the end user some actual agency. And then the other thing is why do we use the term externalized? One of my colleagues at Oxford always says they are things we have externalized. They are not externalities. We actually have consciously chosen to take them out of the equation. And so if we start to talk like that, and we start to think that these are things that we have chosen to consciously take out of the equation, it changes the conversation. So those are all the titles and things that I do. So blended finance, essentially, is a use of grants and other types of grant equivalent institutions to be able to blend different types of capital together, to be able to create situations where we can use capital to the full mandate of a bunch of different types of funders. There's what this report, which was the Blended Finance for Infrastructure and Low Carbon Development report, called the viability gap. The bankability gap for projects. So I'm going to talk specifically about 2 infrastructure projects and then one which is a venture capital project because I know that many in the room spend quite a lot of time in infrastructure. So the first one is something called a climate finance facility. The Graduate School of Business a few years ago, we held what I believe was the genesis of these conversations. It's always hard to tell at the business school. And we had a variety of different funders in the room discussing how we could potentially create a green bank for South Africa, which would be the first emerging market green bank. And the outcome of this was essentially a green climate facility that has been put together by the GCF, the Green Climate Fund, and the DBSA. Both have put in loans and a small amount of grants for the running of the facility to create about 110 million, so relatively small. And just because the size of these are relatively small in dollar terms doesn't mean that they cannot be scaled up. So this is $110 million initial capitalization. The idea is to do climate-friendly infrastructure projects. Where this starts to get interesting is that they're looking to be able to hopefully leverage this capital 5 to 20 times. So we're starting to look at hopefully around the kind of $2 billion of infrastructure projects. How are they able to then leverage this capital? So the GCF has done a loan, which is a below-market loan, alongside DBSAs, and they are then able to go into projects potentially at below market. And again, this is another thing that I always have a problem with, is what is the market, especially when we're talking about some of these things that are brand new markets. So what is a market rate? But essentially they will be able to go in to potentially, if not below market rate, at least sit subordinated. So they can sit below senior debt to be able to pull in additional types of capital that may be hesitant to come into large infrastructure projects. And then also they can play a convening role. And sometimes in these green infrastructure projects, actually what is needed is a convening role. So we'll have the Investex and the old mutuals and others come on board once the projects are put together and once there's a facility created that is able for them to invest in. And this comes down to cost and also just to sheer capacity. So they're hoping to do 5 times leverage, but they would potentially like to go above that. An average blended finance is getting about 5 times leverage, which is below the amount that it needs to be able to globally expand. Another type of structure that we've actually worked on at the business school at the Bertha Center is what we've called the Green Outcomes Fund, the GOF. One of my more brilliant acronyms. So essentially what the GOF is it looks at from a fund perspective, again, around incentives. So how do we incentivize fund managers, in this case, small fund managers, but this could be scaled up to larger fund managers, to go out and prioritize green outcomes? The previous facility hopefully will encourage green infrastructure projects, will encourage funders to be able to develop infrastructure that has a component of being able to be kind to the environment as well as grow profits. These hopefully types of investments are needed at small scale. So energy efficiency, waste energy, clean energy generation, sustainable agriculture. Why aren't venture capital companies, venture capital investment firms going into these types of projects and scale in South Africa? This is my class, so I get to ask questions. Yell it out. Why don't you think they're going in? Returns, absolutely. What else? What type of institutional barriers? Yeah, so I would say energy efficiency is actually pretty easy, but I would say your comment actually really works for waste energy because there's a lot of issues around being able to actually set up waste energy projects. Yeah, I think that absolutely institutional barriers, return, what else? Perception of risk. Yep, perception of risk, and sometimes real, but also perception of risk. So how do we combat that? We can't just say that these don't exist, because we know that both from a real and a perceived perspective, these types of risks do exist. And in some cases, these types of projects will return a lower return than in what the hurdle rate is for these venture capital organizations based off the riskiness of their portfolios. So one of the ways we do that is we bribe them. So we bribe them to create positive social impact. And how do we do that? We created a facility called the Green Outcomes Fund that is currently in contract for funding. That is the legal term that I am able to say from the Jobs Fund. And essentially what this is it is a grant facility, and this could be a subsidized loan facility in further iterations of this. This grant facility that's coming from the Jobs Fund will pay outcomes. We have an outcome chart or an outcome board that we have that the funds themselves will essentially apply for. This will be a incentive payment for creating a megawatt of renewable electricity, reducing tons that go to a landfill, increasing acres of agriculture, sustainable agriculture. Essentially what happens is that these funds that are venture capital funds, I listed some of the ones up there previously, that are for-profit funds that already have funds they're investing in, will be able to bid for incentive payments. What they go out and do is they go out and invest in companies. These companies can be normal companies they would invest in, they can be riskier companies, they can be companies that are going to create more green products or more green outcomes. But essentially what they have to do is they have to redesign their financial models. So their financial models now are looking at the business return from a cash perspective, and they're also looking at the cash that they can make by claiming green outcomes from these organizations, which means that their business models now show 2 different types of cash flows. Cash flows from the business and cash flows from the types of green outcomes they're able to claim from the fund, which means that what we've seen already in earlier iterations of this and now in this one is that this allows these funds to be able to prioritize investing in companies that might otherwise not have hit their hurdle rate. Lastly, this is a infrastructure bond that was done, an environmental impact bond that was done in the US. This falls in the realm of sustainability bonds. Sustainability bonds are part of the $180 billion green bond market, which this year is projected to be about $200 billion. Sustainability bonds essentially link the return of the bond, or the amount that is paid to shareholders, to some sort of sustainability metric. There's been about $36 billion of these done, mostly in Europe in the past couple of years. Companies like Nestle and Philips and water companies essentially agree to issue an institutional bond whereby the interest rate fluctuates based off of Sustainalytics ratings. So the more sustainable they get from a Sustainalytics perspective, the lower interest they pay. The less sustainable they get, the higher interest they pay. These are institutional bonds that are bought generally by institutional shareholders, which means, I'm going to ask my students here, which means that, as we talked about yesterday, these institutional bondholders are using what? Using Sustainalytics as a proxy for? You know this.
Sure, no pressure.
You literally answered this yesterday. What is the Sustainalytics rating a proxy for? Risk. Yes, I heard someone say it, and if I didn't, I'm going to pretend that I did. They're using it as a proxy for risk. By being able to put $36 billion of institutional capital into these funds, they are willing to say that we believe that we will actually take a lower return, but we believe that is a proxy for risk. None of those institutional fund holders are actually taking a lower return in their eyes. In their risk models, they are actually substituting the fluctuation from Sustainalytics as risk. I promise that is, from a fiduciary duty perspective, they're not able to do that. This is an interesting play on this, actually. So it's a little bit further than these Sustainalytics bonds, sustainability bonds that use Sustainalytics. Sorry, that's just one capital, that's one provider. This DC Water bond, essentially what it does is it was an infrastructure bond that was done for water runoff. And it was a program that was needed to be done from local municipality. But what they did is, in building the bond, which they issued, which was relatively small, it was $25 million, they tied the payout to investors of the bond to the efficiency of the water runoff system. So the more efficient the water runoff system was, the higher the return the investors got from the bond. If the water runoff system didn't work, then the investors actually had to make a risk-sharing payment back into the bond. So suddenly you have investors that are, in all intents and purposes, passive investors in this type of infrastructure, actually caring about the environmental impact of this underlying project. It's a really interesting way to tie together infrastructure funding with potential services and results of the fund. I actually forgot to look at what time I came up, so I think I'm done. Cool. Thank you very much.